All right, guys. So thank you so much for joining tonight. So we're kind of doing it a little bit different today, just because we've had a lot of questions with professionals, especially lawyers, since Dave, my business partner, is a lawyer. So we thought we kind of do a different kind of session on, why get into passive investing in real estate. And Dave's just going to tell us his story, how he kind of got involved in real estate, and why you should also get involved as a professional. So I'll let Dave start. And if you guys have questions, feel free to put them in the chat. We'll answer them as we go. If not, we can answer them at the end. And we also have another lawyer from Toronto, Jean-Pierre, that does personal pension plans for professionals in Canada too. So he'll be on board too to answer some questions at the end also. So I'll let Dave start the show.
Okay, thanks everybody for being here 7 o'clock on a Tuesday night. I apologize in advance. I am a lawyer and sometimes I do tend to speak, so I will try not to speak too much and drive you crazy. So before we get started, we always have our little disclaimer that, of course, we're going to be talking about real estate investing. And so our disclaimer is, the purpose of today's meeting is really for discussion purposes. We're not here to provide investing advice, legal advice, financial services advice. If you're to get involved in any kind of real estate deal, you're highly encouraged to do your own research. If anything we tell you seems interesting, we still encourage you to do your own research, consult your experts, your lawyers, your accountants, your financial advisors before making any kind of decision on investing. There you go. There's my disclaimer. And we can move on from there, I hope. Oh, why am I not moving? Here we go. So why are we all here? I think a lot of the people that have joined this particular seminar are professionals. You may not be, but this will still be of interest to you. But if, for a lot of us, we are business professionals and in some capacity. And what I'm hoping to do here today is talk to you a little bit about my goals, my journey to creation of wealth, and really what that means, and how I'm attempting to achieve that with my partner Mathieu in real estate. This is Matt's favorite saying, and it's very apropos to buy land they're not making anymore by Mark Twain. Okay, so what I'm going to do today is I'm going to talk to you a little bit about me, a little bit about my background. I'll talk to you a little bit about what I see as some of the challenges and the hurdles that, as professionals, that we tend to face, and how that affects our ability to generate wealth for ourselves. I'll talk to you a little bit about how I think real estate investing is a good opportunity to deal with some of those issues and to achieve some of the goals that you want to achieve. I'll talk a little bit as well about what we're doing, what Matt and I are doing in terms of our current focus on US real estate investing. And then Matt will talk to you a little bit about some of the projects that we're actually working on, so you get a sense of what we're doing and what is achievable. So me, as I said, I'm Dave Capra. I am a full-time lawyer. I was called to the bar in 2005. I went to law school at the University of Western Ontario. So I've been practicing law for 17 years. I am the managing partner of a mid-sized law firm in Ottawa, with our main office downtown, and we have some satellite offices around the city, and we also have an office in Iqaluit. I should also say I'm also one of the articling principals in our firm. I'm also a full-time, I would say, although it sounds crazy to say, but active real estate investor. I've been investing in real estate for good 15 years or so, starting off with my a couple of small rental properties in Ottawa. I also have a property in Italy. But I started realizing, and I think this will come out a little bit in some of the discussion, that just investing in single family rental units is not the easiest way to generate speedier and longer term wealth for various reasons, which I'll talk about. And I had met Matt again, probably upwards of 15 years ago. I don't remember now. At a business networking group, and Matt was also interested in real estate, and we got talking, and I think I helped him out with a few business transactions along the way. And then he approached me and said, "Why don't we partner up and do some real estate together in the US?" I said, "Yeah, all right." So we've been working pretty hard on that for 7 or 8 years now. And of course, I'm also I say co-founder, but really Matt's the founder of Mada, but I'm the president of Mada Partners. So, often we spend some time, we think about, why, for all those business professionals that are at the seminar today, why did we become professionals? I think there's any number of reasons. I see a few that I've got on the screen. Some of us, we wanted the prestige of being a lawyer or a doctor. Some of us wanted to take on the intellectual challenge and the rigors of going to med school or becoming an accountant or a lawyer. In some cases, there's family history with parents who are professionals, doctors and dentists, and following suit with their parents. Some just want to be successful. Some become a professional because they want to help people. They want to, as often comes up, certainly in my profession, achieve social justice. And some are out there because they want to make money. And I'll stop here for a second, because I always find this is always a very interesting conversation when I'm doing articling interviews with prospective students coming in. And I always ask a question. I ask this question: do you see the practice of law as an engine for social justice, or is it a money-making business machine? And 9.9 times out of 10, the answer I get from the students is, "We're here for social justice." I don't know, you're not. Stop. That's not why you're here. One guy I interviewed this year hit it bang on. And he said, "Well, social justice, yes, that is what I'm trying to achieve. But I get paid to achieve social justice." I said, "You're absolutely right. That is what we do. We're out to achieve social justice and to obtain just results for our clients, but we get paid to do that. That is why we went to law school. It's why we spent so much money going to law school." So both the answers are technically correct, but let's not hide from it. We're all here trying to make some money to try to generate long-term wealth for ourselves. And hence the last bullet point. Part of what we're trying to, I think, as professionals, is we're trying to use that professional designation in order to generate wealth. And of course, the question is, what is wealth? And wealth for each of us might be a little bit different. Some people, wealth is just having more and more money. For some people, wealth is having more time for friends, more time for family, less time in the office, and being comfortable in being able to travel when they want to travel. And I think for all of us, it's probably a combination of all of those things. I think that as professionals, there's a series of challenges that I think, challenges and obstacles that get in the way of our ability to achieve, the wealth goals that we may set for ourselves. And I want to talk about some of those for a little bit. Certainly, excuse me, speaking as a lawyer, one of the biggest challenges or hurdles that we face in our profession is stress. And I think that really applies across the board for all professions. There's we're stressed, we feel overworked. Matt had found for me this statistic that suggested that nearly 66% of lawyers feel overworked and overstressed. 34% are not. And my theory is that 34% are the ones who started to overcome the obstacles and started to generate what I would call wealth, which is the financial ability to slow down, to find that work-life balance, and be successful and enjoy your life. The other challenge we all face as professionals, again, as a lawyer, I absolutely understand this, is the difficulty achieving work-life balance. Working long hours, we find it difficult to find time for friends and family, difficult to find personal time for exercise, recreation, and hobbies. You can ask yourself, and again, this is a question I often ask our incoming articling students, is what's the last book you read for pleasure? And they kind of look at me, reading for pleasure? What are you talking about? I just finished reading a 500-page book on contracts, not pleasure. We just about 6 weeks ago, we had our lawyers retreat where all the lawyers in our firm, we get together and we go up to a cottage just to unwind, tell war stories. And one of the things that we did is we spent a lot of time talking specifically about work-life balance. And unfortunately, I think the one of the takeaways was certainly in the first few years of practice, and again, I think this really applies to most of us, most professions, achieving that work-life balance can be difficult because you're just getting out, you're getting your feet wet, you're developing client base, you're still learning. Your billable rates may not be as high as that you would want them to be in order to achieve your income desires, which then in turn also leads to your ability to generate future wealth for yourself. But what we did find is that after a few years, if you're doing things right, you should be able to start achieving that work-life balance. And if you're doing things really, 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 really right, you're taking the right steps to start investing in yourself and investing in your wealth generating opportunities. I debt loads. And this is becoming more and more true as I talk to incoming students and I hear about their costs of tuition today. They're astronomical. I thought they were high when I went to law school. I graduated in 2005. I remember doing my opportunity costs of higher education for me. And so it's a little bit different because I did have a job before going to law school, but I figured for me, the cost of going to law school with 3 years of not working, cost of living for 3 years, tuition, books, it cost me about $350,000. So for me, I have to figure as I continue in my career, I have to figure out, I got to make that up in addition to generating my wealth for my future. So one of the other challenges I think is a real challenge for professionals is figuring out your retirement planning. When do you want to retire? You want to retire at 90? My mentor, a fellow named Dan McGuire, he retired at 90. And I can tell you, I was at his retirement party and I said, Dan, I promise you, if I'm living at 90, there's no way I'm going to still be practicing law at 90. But what is your retirement age? Is it 70? Is it 65? Is it 55? Those of you out there who may be closer to my age might remember that commercial for the Freedom 55 plan. I used to like to think that I'm on the Freedom 55 plan. But maybe the reality is it's not, I surely hope for most of you it's not 90, but maybe it is 70, maybe it is 65. But maybe the retirement plan is something where you're working less, I certainly know my financial planner, for example, I know he's always told me, I'm going to work forever. I'm never going to stop. But my goal is to work less. So I put on the slide here, what does retirement look for you? Is it spending a lot of time gardening? Is it golfing every day? Or is it just that? Is it working less? Is it working less and golfing more? Is it working less and gardening more? Of course, those are always personal questions to you. The question is, what are you going to do to get there, right? We have all of our lofty goals of what we want to do in retirement, but retirement plans, they need to be funded, right? We need to be generating long-term income and wealth in order to reach your retirement goals. So how do you fund your retirement? Well, for most of us professionals, unless you're a lawyer or other professional working in government, you don't have a pension. So how are you going to retire? I've got a note on here that said, yes, there are changes afoot. Jean-Pierre Laporte is here. He's on the bottom of my screen right now. And he's a pension lawyer involved in setting up personal pension plans for professionals. So certainly he's a good guy to talk to about that. So that's certainly one key. But for right now, for me, for example, I don't have access to that, and others don't. So that is a bit of a challenge for all of us. Some of the other options are, for some professionals, you can sell your practice. My wife, for example, is a dentist, and dentistry is a great business profession to be in, where you have the opportunity that is part of the retirement planning, is that practice that she bought for $500,000, let's say, 15 years ago, is going to have appreciated in value and has built equity in it, because their dental practices are very valuable and they sell very easily. For lawyers, on the other hand, I was speaking to my friend JP McAvoy about this a couple of weeks ago, and he's a corporate lawyer, and say, the problem with legal professions, like for example, most of what I do is personal injury. Well, once my clients are gone, they're gone. So I don't really have anything to sell. So that's not necessarily, may not be the best avenue for me, is selling a practice. That's probably not the cornerstone to my retirement. Personal pension plans, as I said, Jean-Pierre is here, and that is an option. I won't speak to it because I'm certainly not a professional on it, but at the end of the presentation, certainly if Jean-Pierre wants to speak, or if anybody has questions, you can certainly have at it. Private investing in the stock market, investing through your RSPs are all certainly noble goals towards your retirement plan and your wealth generating plan. And then there's real estate. And of course, this is the one that I'm most interested in, because I think it offers really strong opportunities for people to generate wealth. On this screen, I have a quote up, and this is again a quote from my mentor, Dan McGuire. When I first started practicing law, and he just looked at me and said, "Dave, the practice of law won't make you wealthy. It's how you invest your earnings through law that will make you wealthy." And I always took that to heart, and he was right. So why real estate investing? Why am I excited by real estate investing? Well, there's a few things, and just a few of them I've put up on the screen. So cash flow. You buy a rental property, and if you've done your job right, you've done your due diligence, and it's generating enough rental income, that rental income is paying off your mortgage and is generating some what we sometimes call mailbox money coming into you every month. Tax breaks and deductions. Again, you'll want to speak to your accountants about this, but certainly there's a lot of tax advantages to owning real estate. The interest on your mortgages is tax deduction. All of your expenses, condo fees, repairs are all tax deducted. You don't get that on your personal home, right? Appreciation over time. Property appreciates over time. Every economist will tell you, yes, there's sometimes some dips in the real estate market, but ultimately it's an upward trend, and it always has been. And as far as I'm concerned, it always will be. Building equity and wealth. Like, this is just, it's brilliant, right? You buy the property, somebody else rents it, they pay down the mortgage for you. And as they pay down that mortgage, you're building equity. You're building equity without putting any more, except for your down payment, without putting more money into it. And as that equity grows, your wealth grows. Portfolio diversification, as I said, in my view, I wouldn't tell anybody put all your eggs into the real estate basket. You should be putting your eggs into multiple baskets. We talk about whether it's through stock market or through your RSPs or through a personal pension plan. But real estate is a great way to make sure that your investing portfolio is diversified. Leveraging. Again, one of the great things in real estate is you can buy a property, add value to it. And again, if you do things right, once you've done adding value to that property, often you can refinance and take much of your initial investment back out, leverage it, move on to the next property. Or even if in a few years, as the equity is building up and the value is appreciating in that property, you can refinance and take money out and reinvest it into more property. So real estate's a great opportunity for leveraging. Real estate's also a great inflation hedge. I won't get into great detail about it, but most economists will tell you that real estate is a great hedge against inflation. As inflation goes up, typically the value of property goes up. Typically rents go up. So your investment is typically going to be protected. There's a lot more to it, but for the interest of time, I'm not going to go into much more detail about that. So my investment criteria. So there's a few things that, certainly when I'm looking at it, when Matt and I are looking at investing in real estate, one of the things we look at timelines. And for us, our investment timelines on any given project vary anywhere from a shorter term project of 8 months to a longer term, probably a larger project of 36 months. Exit strategies. When we're looking at projects to invest in, we're looking for exit strategies. We're looking to know how quickly we can get our money back out. So if we invest $100,000 into a project, how quickly can we get all of that money out? Will we get 80% of it out in 1 year? How long will it take to get the 100% out? We're also looking in our exit strategies. We look for, I know Jeremy is on, who's one of our partners for our US investing, and he's the king of the exit strategy, always looking for different alternatives for exiting out of a project when better opportunities may arise. So we're always looking for our exit strategy, making sure that we're able to get our money out as quickly as we can, because we don't want it sitting forever. We want it moving on to other projects. The returns, of course, when we're looking at our projects, we're looking for the returns. And most of our projects, we're looking at a minimum an 8% preferred interest rate on our money while it's being invested. And then we're looking to, I think probably the worst that we've done is about 10% returns. We've also had some returns, 40, 50%, not that I'm making any kind of guarantees to anybody, but we have had those successes, but we've probably averaged somewhere in the range of 15 to 20% on other projects that we invest in. And then lastly, when it comes to, my investing criteria, I'm looking for the team. So for me, my team and my Canadian team, so kind of funny to say, as I'll explain, it's myself and Matt. We've also, Elliot is our cross-border accountant. And so he's a great guy to provide advice to us on our transactions in the US. And then we also, so as Mada Partners, we team up with our preferred developers in Philadelphia, where we spend most of our time in the US. And so we spent a lot of time working with our partners, developing our relationship with our partners, and getting to know each other really well. So we've developed a really strong bond and trust with each other as we go out and we develop real estate together. Those are very important aspects in terms of how we approach investing in general, and particularly in the US. So I can tell you that, when Matt and I got started, we were investing in pretty small stuff, like single family home flips, maybe a duplex or a triplex, which in the big scheme of things is pretty small. Now our focus with our US partners is really in multifamily. As noted on the slide, 1 to 4 units is really still considered single family residential real estate. Once you get above 5 and 6, you're now sort of dealing in at commercial level, and there's really great advantages to investing in multi-family real estate. So again, I'll talk a little bit about it. So the financing in multi-unit commercial is easier. Cash flow is more consistent and stronger, more reliable, and you can achieve some economies of scale. So let me talk about that. So from an economies of scale perspective, you have occupancy benefit. So if you have a single family home and you're renting it to one person and they leave, they're gone. You've got nobody left paying that mortgage. So now it's you. And I've been there. My first rental property was a single family home, and I rented it to a fellow. And after a year and a half, he left, and it took me 2 months to get a new renter in. And during that time, there was nobody paying that mortgage. So that was coming out of my pocket. When you're in a multifamily property, let's say you have 6 units and somebody leaves, if you've structured things properly, that one vacant unit is not going to break your ability to meet your mortgage. The remaining rents will continue to cover your mortgage payments and all the rest of your expenses. The cost effectiveness of renovations, the more you scale your project, the more units you do, the cost of construction is going to go down. The cost of, for example, in a lot of the units that we build, we put appliances and everything, washer and dryers are in the units. So we're buying all those things. Well, if you're buying for a single family home, you're going to be paying basically full retail. But if you're buying to put washer, dryer, dishwasher, fridge, stove into a 50-unit building, you're going to get a really good discount on those appliances. Same with property management costs. Again, if I were to have my single family unit managed by a property manager, I'm probably going to be paying 7 or 8% of the rent every month. And then often what they do is they charge you, the cost of 1 month's rent just to get a new tenant when the tenant leaves. When you're dealing with a larger scale projects, like let's say 50-unit building, well, you're probably not going to be paying 7 or 8%. You're probably going to be paying something closer to 5%. So your costs are going to go down. So financing, when you're dealing with single family dwellings, you're financed based on your ability to pay. So that's going to make it harder once you're out 5 units, 6 units out, you're going to have a harder time financing those projects, because it's all going to be, the banks are going to look more and more at you and your ability to satisfy the mortgage. But when you're dealing with larger commercial multifamily projects, the banks are more interested in net operating income. They're less interested in you because they know that multifamily projects are more stable. They know there's more rent income coming in to cover the mortgage. So it's a lot easier to get financing for more and more projects that you want to do. Again, I've touched on this a little bit, consistent cash flow. Again, when you only have one or two renters, one of them leaves, just one of them, your cash flow is taking a pretty significant hit. When you have 5, 6, 7, 8, 10 tenants paying rent, one or two, even three of them leave, it's going to have a pretty minimal impact on your cash flow. And of course, cash flow is what you need to pay your mortgage and pay the rest of your expenses. So I've talked about this a little bit, alignment and partnering. So I've mentioned, I think it's that within the Mada organization, we have myself, Matt, and Elliot, who we work together in investing, and mostly, again, investing in the US and particularly in Philadelphia. I mentioned that Jeremy Tur is on the line. He is the fellow that we do most of our investing with. He's our key development partner in the US, and we've been working with Jeremy for 7 or 8 years now. We've developed a strong bond and strong connection and strong level of trust in doing business together. And so I would suggest to anybody, if you're going to get into real estate, it's going to be really important for you to find a good team. And again, that team is a team of like-minded people. Your team can and should include your lawyer, your real estate lawyer, your financial advisor, your accountant, in order to make sure that you're covering off issues. Like we can't always think of everything, but if you've got a good team who sort of multifaceted team of people who know different areas, they can help you make sure that you're successful in your investing adventure. Oh, I've mentioned quite a few times now that we focus a lot on US real estate, and frankly, most of our real estate investing at the moment is in Philadelphia. So the question is that I get a lot is why US real estate? And I think there's a few things that are important. Number one is accessibility. There's just so much more. There's so much more opportunities available. The financing structures that are available are just different from what you have in Canada. The opportunity to be creative in your real estate deals is much better in the US. We have set ourselves up, so that's one of the advantages. So that exchange, 1031 exchange that Matt's talking about, is an opportunity that we've been able to take advantage of with the help of our US partner to take our money out of projects once we've relieved ourselves of those projects and not pay tax on those earnings, and instead roll them over into other projects for tax deferral, essentially. One of the other advantages that we find in investing in US real estate is simply the costs. Soft costs in a project, so everything from your architectural fees, design fees, inspections, real estate transaction conveyancing costs, insurance, professional fees, and land acquisition. In Canada, a lot of times these fees can be $90,000. In the US, a lot of times we're getting in at $20,000 for those types of fees. Hard costs, your building material, your HVAC, windows, etc. In Canada, we're typically, again, as a general benchmark, you can be looking at, on average, $290 a square foot. In the US, we're probably typically looking at $165 to $180 per square foot. So just the cost of construction is substantially lower in the US, which just means more more profit back to you as the investor. So that's what I have to say, and that's where I've come from. And now I'm going to turn it over to Matt. And Matt's going to talk a little bit more about the work that we are doing now, to give you a sense of where the actual work on the ground that we've done.
So this is just a small project that we're hopefully the foundation is going in this week, but just to show people like the difference of doing business in the US and in Canada. So this one's a 6-unit that we're building. We've invested $300,000 US in it. So pretty much our acquisition cost for the land was roughly $175. Our hard cost is around $736. Our soft costs $76 on it, and then our developer fees are around $50,000 and around $30K for the financing. So it brings it up to around $1.1 million to build this. So when you think about it in the grand scheme of things, when you're trying to build a product like that in Canada, you need a lot more capital to do something like that. So this is part of the reason why we really enjoy US real estate, is that you need less money to have just as good result in Canada. And the beauty about a project like that is that, you know, you can recycle your capital a lot quicker. In this particular instant, our goal is to build it and sell it to another group of investors in the next 12 to 14 months once we're completed. So our target is around 9 months of construction, 2-3 months to stabilize it with tenants inside, and then hopefully sell it to another group. And we're pretty excited on that. We're hoping to sell it for roughly 1.4 to 1.5 million. That's our target on something like that. And then on our next slide, this one's it's, if you want to switch your slide there, Dave.
Yeah, sorry, I'm trying. It's not. There you go.
So this one's another one that we're super excited to be building something like this. So this one's 26 residential units. It's a different piece of land. So basically on the piece of land, we're going to have a 10-unit apartment building, 8 duplexes. On this guy too, we have, I believe, 8 garages and 7 surface parking spaces. And we're hoping to start this in the fall, but just to show you the amount of money you need to build something like this compared to Canada is so different. So the total raise on this for us is a $1.6 million raise. Our acquisition cost, give or take, for the land was around $1 million. We've got our hard costs is around just over $5 million. Our soft costs $350, our developer fees, and then our financing costs. So if you look at a project like that, you know, you're just over the $50,000 mark, I believe, on this one for to build and per unit. So in Canada, you'd have, again, to inject a lot more money to build something like that. So that's the reason why, you know, when you're investing in real estate, you can scale a lot quicker in the US with a lot less capital. I'll get you to go to the next slide. So a lot of the stuff that we kind of look at, you know, we look at, you know, sometimes we'll have like shovel ready buildings, so we don't even build it, we just sell it to somebody else. You know, we're doing land assembly. This one was a land assembly. It took forever for our US partner to assemble the land on that particular piece of property. We've done a couple of rehabs right across the street from it to create more comps and to create a more vibrant dynamic. And we've also done kind of like facelift projects where we essentially buy a shell of a building. You know, we might add an extra floor to it, but we try to recycle the majority of the building to bring back our costs a little bit lower when we're doing that. There's also a key feature if you want to go to the next slide, Dave, please. So there's also, again, the tax advantages. There's opportunity zones where, you know, if you hold the property for over 10 years, there's no capital gains tax on the federal side of things. The city of Philadelphia has tax abatements. They changed that a little bit this year, but essentially you're getting a discount on your property tax. So all these little advantages that you're getting in the US are really good again for cash flow. And when you utilize, the tax portion of things, it's kind of like your cherry on top of your sundae to get better results and to use that to your advantage to multiply your money. So the way we kind of work, if you want to go to the next slide, Dave, with us, if people want to partner with us or they have questions, we have, if you're a professional, you have your corporation. Instead of using RSPs, we partner with Integris. They set up personal pension plans for professionals. People can directly invest with us to get preferred rate of return in equity, or you can just get a fixed return with no equity. So there's a few different ways that you guys can invest with us. And if you have more questions, feel free to ask some more questions. But again, everybody, thank you so much for coming online today.
Thanks, folks.
If you guys have questions, feel free to ask questions. We've got JP, the pension plan lawyer, on the line. And we also have our US partner. Sometimes he's shy, sometimes he's not shy. We can put him on the spot too.
So Mathieu, if I may just say a few words, because I know David's thrown around the concept of personal pension plan in a few slides, and if I may spend just 10 seconds on that. Personal pension plans are the most tax-effective retirement plans in Canada in terms of how much money you can contribute and deduct from your income. And what's beautiful about them is that, unlike RRSPs that have a whole bunch of restrictions on what you can invest in, personal pension plans are more permissive. So a lot of deals that would not be RRSP eligible can be PPP eligible. So that just makes it easier to get into US real estate. And when you make money, you're not paying tax on it at all because it's all held within a pension plan. Unlike if you're using a non-registered account to do your investments in the US, you do eventually have to pay some Canadian tax on the growth of that money. So that's the quick, short, and sweet kind of summary. I'm happy to take any other questions, but I just wanted to clarify that for the listeners.
Anybody have questions? Because you got a whole bunch of professionals that usually charge too much an hour to ask questions if you want. All right, guys. Well, I appreciate everybody coming on. I'll send everybody a recording. If you have any questions, you guys know how to contact us. But happy to share all the information that we've been learning during this journey. All right, guys. Thank you so much. Have a great night. Take care.
Thank you. Good night.
Thank you, guys.